Hi, my name is Brianna Choi and I'm a Senior Financial Advisor at Perpetual Private. Today I'm here with Andrew Garrett, Perpetual Private National Investment Specialist, talking about responsible investing. Andrew, responsible investing has been such a popular topic in recent time, and I'm getting a lot of questions from my clients about it. Can you tell us what exactly is responsible investing and why it's growing in popularity?
It really is a good question, and it's, I think it's first important to draw out the fact that responsible investing and ethical investing, sustainable investing, ESG investing, these are all terms that are used interchangeably. And the reality is that there are some reasonable nuances between them. So it's certainly important understanding what those nuances are before going down the path. You know, when we look around the world and consider why these have been gaining more attention, there's a couple of things. First of all, you know, this isn't new. It's something that's been developing for a number of years. Certainly there are structural things such as, you know, the Paris Climate Accord, which have encouraged it. But equally, people are becoming more aware of the impacts on the world and the influence that, you know, an appropriate investment strategy can have to not only generate investment returns, but also do good.
So for those clients or investors who are interested in responsible investing, what are the investment options that are available to them?
There's a growing amount of investment options for those people who do have some sort of, you know, additional expectations from their investments. And when I say additional, we're talking about those responsible elements. In its most basic sense, you have something called negative screening. So that might be, you know, where I'm trying to avoid investing in fossil fuels or you know, companies that have behaved badly. So we all know, you know, recent examples of companies that have gotten themselves in trouble with not considering the fact that they have a broader social responsibility other than simply generating profits. So outside of the negative screening approach, you then move up a bit and you have something that, you know, is more positive engaged. So you're looking for companies that, or investments in general, that have a positive impact on the world, you know, whether that's improving you know, water availability in developing nations, or whether that's simply, you know, people working to drive the efforts towards more sustainable energy production.
I've got another question for you, and this is a question that I frequently get from my clients. So I want to talk about financial performance. So how do returns for ethical or responsible portfolio compared to traditional unscreened portfolios?
I think if you went to someone who is more of a traditionalist mindset, they would assume that you're going to inhibit performance returns by placing restrictions on the way investment managers can invest. I think the key thing for us when we consider this is when you look at the meta-studies, and a meta-study is a study of other studies, what you actually tend to find is these sort of extra considerations, if anything, they don't tend to hurt performance, and in some cases they actually improve performance. And of course that stands to reason. In a lot of cases what it really means is the investment managers having to look even closer at the company or you know, the investment than they otherwise would. So what it really leads to is a deeper level of due diligence.
Andrew, thank you so much for your time today. Responsible investing is personal. As an investor, it's really important to think about what are the causes that you really deeply care about and how you can translate your values into your investment strategies and how it fits into your overall financial plan. Thank you.